Hi everyone, so today is Wednesday the 6th of May. We are about 20 minutes before the US session opens and I'm here looking to see how long this rally is likely to continue for. And if you recall from the previous videos, we have marked these levels as high probability areas, high trade areas where reversals are likely to take place. Now, if we look at seasonality seems to be winning right now. What do I mean by that is that over the last 25 years or so, typically this pattern that we see here in April is pretty consistent with the averages over the last 20 to 25 years. So despite in March me having a belief that we had a point of control over here at 6,650 around here, despite thinking that beyond that we're going to see another 800-point drop, what ended up happening is that seasonality has taken hold. It seems to have won, and positive earnings, positive sentiment has really just outweighed the negative sentiment of any war or anything like that. So this is why we see the increase in price over the last few weeks. But what is interesting is that me as a former institutional trader, large trader, along with a lot of people in the city, a lot of hedge funds have been calling this short for a long time as well. And the reason we know this is because if you look at the large reported data by the CFTC, you will see that hedge funds have a very, very large short position on their books, right? So they've been reporting, I think it's like 20% of OI, just of open interest. Just give me 1 second. I'm going to see if I could get that up on the screen. So this dashboard is in build at the moment. I am building this. Really, the reason I've done this is because not every retailer has access to this level of data, which Bloomberg will offer you for $2,000-3,000 a month, whereas this is something that's actually available for free. And now we could get AI to construct the methodologies and the logic behind there to really give us the same sort of level of information without having to cleanse and enrich that data ourselves. So I take it direct from the regulator, where the hedge funds, asset managers, all the actors in the marketplace will report, and then we just form a picture on what their books look like. So over here we can still see that hedge funds are 20% of open interest. That's their short position. So that's huge. That's massive, because typically this should be hovering around sort of 10% of open interest. You'll see that's where hedge funds are in the marketplace, and dealers as well. Now, dealers is a bit more of a complex story because their short position is not really any there's no technical strategy behind it. That is they are a mechanical participant. In other words, they're balancing several factors on their own books, and they have to take these positions. Now, this software I'm going to be making available for free, or should I say for the price of a coffee to a pizza, that kind of cost per month. So it's going to initially be free because the accuracy is not 100% there right now. There's certain things we're never going to ever be able to capture, because this, I mean, by default, the reporting cycle means that this is always going to be delayed data. Not even Bloomberg, no one's going to get this more up to date than the reporting cycle. Reporting cycle is every Friday, and it's based on data from Tuesday. So today we are kind of like 1 week late on the data. But everyone, this is an efficient market because everyone, whether it's JP Morgan, or Goldman Sachs, or whether it's me sitting here in my office just talking about it, we all have access to the same level of data. But there are some nuances around that as well. Sorry, but this is the accurate one. So we know that the hedge funds are still heavily short. Okay, and not only that, we also know, if we compare it to last week's, if we compare it to the behaviors over the last few weeks, we know that they've been short for a long time. You know, look at this throughout April. So that percentage short of open interest has been there since sort of the end of March, which means that this tells a fundamental story. And I highly encourage you to follow me on Buy Me a Coffee, where I will be setting up a profile. I will be getting things live on that, but then it encourages me to continue building this, and then you get access to institutional level data for a fraction of the cost. Now I'm going to just quickly go through some of the levels here that we're seeing at the moment. I reported this last week that the hedge funds should be closing out now. They should be at the top of their margin stress. So we should start seeing that price rise come to an end maybe in the next week or so. But these levels are still crucial. The one that I called on for the 30th of April for a potential reversal at this point, and also at 784. So obviously the one that was wholly incorrect was the one at the 1st of May, because that Friday, going back up, I think what we 1, 2, 3 business days, 2.5, 3 business days ago, we should have been seeing these kind of levels. So there's 2 key factors to take away from this. One, we know that hedge funds need to start closing up, so we might see it. Maybe this rally has been part of that closure, because as I said, the data is delayed, so we don't truly know. And the second thing is that we need to see the behavior of hedge funds relative to open interest. So the price relative to open interest, that's going to give us an indication of hedge funds closing, and I'll do that in another video. But I do encourage you, I'll put a link in for the Buy Me a Coffee link, and it's just going to be a very informal dashboard that's being built, but you're going to have access to Bloomberg level information, and that's the crucial thing. And then you'll be able to make some key decisions off the back of that. You won't make mistakes like this, where we're going in with a bearish view and you see all these hedge funds are heavily short at these levels, which means they need to cover, and as they cover, the price starts to rise. But that's only one participant in the market. Okay, so we're going to watch this. I'm hoping that at this sort of level, I'm not going to change any of these levels right now, because the volume profiles seem pretty consistent. I'm hoping that we see some kind of spikes up to 7385, and then that, depending on what comes out this Friday, again, that will suggest that we are finally heading to that kind of top. But I need to see what data is released this Friday to decide how much exposure there still is out there with the hedge funds. I'm hoping eventually we see some news over here and see that, okay, look, hedge funds are now closing off, the open interest has gone down, the price is converged, and then we see the price come down considerably. Okay, so this is the key level. I'm not going to change this. We're going to actually, what I am going to do though is take a quick look at volatility. So we can see here, look, there's a volatility trap taking place, or underway, should I say, sorry. And we can see implied volatility. This white line here is now below historical volatility. So usually what investors and institutions do at this level is start to buy that volatility. They expect volatility and volatility doesn't necessarily mean, I think it's quite often understood that it means that prices are going to plummet. No, that's not. Volatility usually volatility by definition means that the expansion and contraction of that price starts to get wider and wider and as a result of that hedging and purchasing of those options, those insurance premiums, we see the price decline. So the decline in price is a consequence of that expectation in high volatility. But anyway, we can see that we expect some kind of volatility spike here, and that will lead to a price decline at some point. So let's keep watching. 7400, 7385, 7400 on the ES. Take away about 25 points for that. For the SPX takes us to around, I think it's 7360. 7360 is where we. So let's add another 10 points to that, 15 points to that on the SPX. Let's get that in now, and we should have an indication of where that's likely to be. Let's go about here. For the SPX peak, we're really nearly there, about 20 points more on the SPX. I think it's going to go a bit beyond that. Let me just see this again. Sorry, I've done the calculations wrong. Oh no, that's a considerable rise. Sorry, I've messed that up completely. 7385 minus 25. It takes us to around here. 7385 minus 20. Yeah, I was only about 100 points away. That's where we're looking the SPX to go. Around there, 785, 400, 7. Yeah, let's go to about here. That's a bit excessive, but that's where we expect prices to start settling if, hedge funds are still unwinding. Okay, so I'll put the link in for Buy Me a Coffee. You'll get access to that system fairly soon. You'll get access to the beta version that keeps changing, but eventually when it's locked in, you're going to get to see other things as well, like in terms of what Congress are buying, people in Congress, what they're buying, and just other important levels, news, things like that. It's all going to come together in that piece of software, and you're going to get it for next to nothing at this moment in time before it actually goes out to the final market. It's going to be this way for at least 6 months or so as I build it incrementally, and I hope you benefit from it.